Stop scrolling. Imagine putting a portion of your hard-earned paycheck into your 401k every single month for 30 years. You trust the process. You trust the glossy brochures with the smiling retirees on sailboats. And most of all, you trust the highly paid Wall Street professionals managing your money. But what if I told you that the entire system is tilted against you? What if the star fund managers heavily promoted by the financial media are not financial geniuses at all, but rather salespeople operating a massive, perfectly legal skimming operation designed to quietly drain your life savings? Today, we are going to expose the illusion of the star fund manager. We are going to look under the hood of your 401k to reveal the hidden fees and kickbacks that are silently eating into your nest egg. And I'm going to give you the exact blueprint to bypass this trap and take back control of your financial future. I am the Wealth Guardian, and the mission of this channel is to protect your wealth through education. We bridge the gap between complex financial jargon and practical, real-world asset protection. If you are serious about keeping what you have worked so hard to build, please hit the like button, subscribe to the channel, and ring the bell notification right now. I also highly encourage you to watch this video all the way to the very end. The final strategy I'm going to share with you, a specific method to bypass a terrible company retirement plan, could literally save you hundreds of thousands of dollars over your lifetime. Before we go any further, an important reminder. Everything in this video is strictly for educational purposes. Nothing here constitutes legal or financial advice tailored to your personal situation. Always consult a qualified professional for your specific circumstances. Let us get into it. Wall Street relies on a very specific narrative to justify the exorbitant fees they charge you. That narrative is the myth of the star fund manager. They want you to believe that if you just pay them enough, their team of Ivy League analysts can outsmart the market, pick the winning stocks, and dodge the loser. They call this active management. To sell this illusion, the financial media constantly hypes up whoever happens to be winning at the moment. Take Bill Miller, for example. From 1991 through 2005, that is 15 consecutive calendar years, Miller managed the Legg Mason Capital Management Value Trust, and it beat the S&P 500 index every single year. The financial press hailed him as a genius, a legend, the iconic fund manager of his generation. But what the media failed to emphasize was the statistical reality behind his success. Out of thousands of mutual fund managers trying to beat the market over that same stretch, Miller was essentially the only one to accomplish that specific 15-year streak. Just one. Now, I want to be fair here. There's a legitimate debate about whether Miller's streak was pure skill, partially luck, or some combination of both. But that debate itself is the point. If it takes a once-in-a-generation anomaly to even have the debate, what does that tell you about the other 99-point-something% of fund managers? And what happened next? Eventually, his hot streak ended, and it ended violently. In 2008, his flagship fund lost roughly 55% of its value in that single year, massively underperforming the S&P 500, which itself fell about 37%. By the time the dust settled, the fund had given back years of outperformance. In fact, if you looked at Miller's full track record, including the crash, his long-term numbers were far less impressive than the headline streak suggested. This is a phenomenon called reversion to the mean. Past performance, no matter how spectacular, tends to fade back toward average over time. And that is not just my opinion. It is one of the most well-documented findings in all of financial research. Let me throw some numbers at you because the data on this is absolutely devastating for the active management industry. The best source we have is something called the SPIVA scorecard that stands for S&P Indices versus Active. It is published by S&P Dow Jones Indices, and it has been tracking the performance of active managers against their benchmark indexes for over 20 years now. Here's what the data consistently shows. Over a recent 15-year period, approximately 88 to 92% of actively managed large-cap U.S. stock funds underperformed the S&P 500 index. Let me say that again. Roughly 9 out of 10 professional stock pickers with all their research teams, all their Bloomberg terminals, all their Ivy League pedigrees, failed to beat a simple index that you could have bought for almost nothing. And it is not just large caps. The numbers are similarly dismal across mid-cap funds, small-cap funds, international funds, and bond funds. No matter where you look, the vast majority of active managers lose to their benchmark over meaningful time periods. Now, some of you might be thinking, okay, but what about the 10% who did beat the index? Can I just pick those winners? And that is a great question. But here is the kicker. The research also shows that past winners almost never repeat. A fund that outperforms in one 5-year period is no more likely to outperform in the next 5-year period than random chance would predict. It is like trying to predict which slot machine in Vegas is due for a jackpot. The past tells you almost nothing about the future. So if these highly paid, actively managed funds consistently lose to the market, Why on earth are they stuffed into your 401k plan? Why doesn't your employer just give you the option to buy simple, low-cost index funds that track the market and, statistically speaking, will outperform the vast majority of those actively managed alternatives? This is where the system really starts to smell. The 401k system, as it has historically operated for many workers, often functions as a giant fee extraction machine where brokers, insurance companies, and mutual fund companies work together in ways that do not serve your best interest. It all comes down to a practice known as revenue sharing, which is essentially a polite, industry-accepted term for a kickback. Here is how the arrangement works. A broker, financial advisor, or retirement plan consultant approaches your employer and offers to set up and administer your company's 401k plan for free, or at a very low visible cost. Your employer, understandably looking to save money and not wanting the administrative headache, agrees. But in exchange for this free administration, the broker gets significant influence, sometimes exclusive control, over which mutual funds go into your plan's investment lineup. The broker or plan administrator then turns to the mutual fund companies and says, if you want your fund on our platform, you need to share a portion of your management fees with us. This is revenue share. The expensive, actively managed funds that agree to pay these revenue sharing fees, sometimes 25, 50, or even 75 basis points, get placed into your 401k menu. The low-cost index funds, which charge so little that they have almost no margin to share, are often shut out of your plan entirely. Now, I want to be precise here. Revenue sharing is legal, and in recent years, thanks to increased regulatory scrutiny and a wave of class action lawsuits against plan sponsors, the landscape has been slowly improving. The Department of Labor has tightened fee disclosure requirements. Many large employers have added index fund option. But, and this is a big but, millions of workers, especially those at small and mid-sized companies, are still stuck in plans loaded with expensive, underperforming funds. The problem is far from solved. Let me pause right here and ask you a direct question. Have you ever actually looked at the prospectus or the fee disclosure for the mutual funds inside your 401k? Have you ever checked the expense ratio of the funds you own? Drop a comment below right now. Tell me if you know exactly what you're paying, or if you assumed your 401k was totally free. Let's get a real conversation started in the comments section so we can all learn from one another. I read every single comment, and shining a light on these hidden fees is the first step to protecting our wealth. You might think a small fee does not matter. If an actively managed fund charges 1.5% per year, and an index fund charges, say, 5 basis points, that is 0.05%, well, that is a difference of about 1.45%. Who cares, right? You should care desperately. In the world of compound interest, small percentages create massive differences over long time horizons. And the reason is intuitive once you think about it. Fees do not just take money out of your pocket today, they also take away all the future growth that money would have generated for the next 20, 30, or 40 years. The Department of Labor has published guidance on this, and their example is striking. They note that even a 1% difference in annual fees can reduce your total account balance at retirement by roughly 28% over a long career. Let me put real numbers on that so it hits home. Let's say you contribute $500 a month for 35 years, and the market returns 7% annually before fees. With a low-cost index fund charging 0.05%, your ending balance would be approximately $860,000. Now take that same scenario, but with an actively managed fund charging 1.5%. Your ending balance drops to roughly $630,000. That is a difference of over $230,000. And remember, the expensive fund most likely underperformed the index fund in terms of raw investment returns on top of that. So the actual gap could be even wider. Think about that. $250,000 gone. Not because of a market crash, not because of bad luck, but because of fees that were quietly, invisibly deducted from your account every single day. And here's what really twists the knife. The fund companies and the brokers get their fees, whether the market goes up or down. They get paid in bull markets and bear markets alike. You shoulder 100% of the investment risk, and they take their cut no matter what. Because the fees are automatically deducted from your returns before you even see your account statement, you never write a check. You never feel the pain of handing over cash. The wealth is drained invisibly, silently, year after year after year. Wall Street has engineered this system with extraordinary precision. The complexity, the jargon, the fine print. It is all designed to keep you from asking the one question that matters. What am I actually paying? And what am I actually getting for it? So, how do you beat this system? How do you stop the silent bleed from your nest egg? It is time for your Wealth Guardian action plan. I have got 4 concrete steps for you. Step 1. Reject the illusion of the star manager and embrace passive investing. You have to internalize this truth. Trying to beat the market by picking actively managed funds is, for the vast majority of investors, a losing game. The data is overwhelming. Instead, you want to capture the market's returns by using index funds. An index fund simply tracks a broad market benchmark like the S&P 500, the total US stock market, or a total international stock index without paying a team of analysts millions of dollars to guess which stocks will go up. Because their overhead is so low, their fees are a tiny fraction of what active funds charge. We are talking expense ratios of 3, 5, maybe 10 basis points versus 100, 150, or even 200 basis points for actively managed funds. And because index funds are not constantly buying and selling, generating trading costs and taxable capital gains distributions, they are more tax efficient in taxable accounts as well. The beauty of this approach is its simplicity. You do not need to watch CNBC every day. You do not need to research individual stocks. You do not need to guess which fund manager is going to be the next Bill Miller. You just need to buy the whole market, keep your costs low, stay diversified, and let compound growth do the heavy lifting over decades. Step 2. Audit your 401k plan. This one is homework, and I want you to do it today. Log into your 401k account and look at your investment options. Are there low-cost index funds available? Look for funds with the word index in the name, and check that the expense ratio is well under 0.5%, ideally under 0.1%. If your plan offers a low-cost target date retirement fund, one that automatically adjusts your mix of stocks and bonds as you get older, and is built using underlying index funds, that is often a phenomenal set-it-and-forget-it option, especially if you do not want to spend a lot of time managing your allocations. Just make sure the target date fund itself has a low expense ratio. Some target date funds from certain providers are built with expensive active funds underneath, so always check the all-in cost. Also, look for your plan's fee disclosure document. Your plan administrator is legally required to provide this to you at least annually. It will show you the total plan costs, including administrative fees that may be deducted directly from your account balance. Many people have never read this document. Read it. Step 3. Lobby for a better plan. If your company only offers expensive, actively managed funds or worse, insurance company products like variable annuities wrapped inside a 401k, you need to speak up. Under the Employee Retirement Income Security Act, known as ERISA, your employer has a legal fiduciary duty to ensure that the plan's investment options are prudent and that the costs are reasonable relative to the services provided. Here is something that might surprise you. Often, the human resources executives or small business owners who selected the plan have no idea how expensive it actually is. They trusted the broker or insurance agent who sold it to them and never dug into the details. Sometimes all it takes is an informed employee presenting the data to trigger a plan review. Band together with your coworkers if you can. Request a formal fee audit. Present the SPIVA data showing how active funds underperform. Formally request the addition of low-cost index funds from providers like Vanguard, Fidelity, or Schwab. And if your employer is unresponsive, you can also file a complaint with the Department of Labor's Employee Benefits Security Administration. The threat of regulatory scrutiny alone can be a powerful motivator. In recent years, there have been numerous high-profile lawsuits, including cases against major universities and large corporations, where employees successfully sued their employers for offering excessively expensive 401k plans. The legal landscape has shifted dramatically in favor of employees on this issue. Step 4, and this is the big one I promised you at the beginning: cheat the cheaters with an IRA. If your employer absolutely refuses to fix a terrible 401k plan, and they do not offer a company match, you might want to consider stopping your contributions to that plan altogether. Instead, open your own individual retirement account, an IRA, at a low-cost brokerage like Vanguard, Fidelity, or Schwab. Inside an IRA, you have total control. No broker can restrict your investment choices. You can build a beautifully diversified portfolio of low-cost index funds entirely on your own terms. A simple 3-fund portfolio, a total U.S. stock market index fund, a total international stock index fund, and a total bond market index fund gives you global diversification at a cost of just a few basis points per year. Now there is an important caveat here. IRA contribution limits are lower than 401k limits. For 2024, you can contribute up to $7,000 to an IRA or $8,000 if you are 50 or older. Compare that to the 401k limit of $23,000 or $30,500 if you are 50 or older. So if your employer does offer a match, absolutely contribute enough to your 401k to capture every single dollar of that match. A match is free money. It is an instant 100% return on your contribution, and no investment in the world can beat that. But once you have captured the full match, direct your additional retirement savings into your own IRA, where you control the investment options and the fees. If you max out your IRA and still have more to save, then go back to the 401k for the tax advantages, even if the fund options are not ideal. The tax deferral still has real value. And one more thing, if your income is too high to deduct a traditional IRA contribution or to contribute directly to a Roth IRA, look into the backdoor Roth IRA strategy. It is perfectly legal. The IRS has effectively blessed it, and it allows high-income earners to get money into a Roth IRA regardless of income limits. I have a separate video on that strategy linked in the description below. The financial industry wants you to believe that investing is impossibly complex, that you need their highly paid experts to guide you, and that their fees are a small price to pay for their genius. It is an illusion. The reality is that simple, low-cost, diversified investing mathematically beats their expensive strategies the vast majority of the time. You do not need a star manager. You just need the discipline to keep your cost low, stay diversified, and capture the growth of the global economy over time. Knowledge is the great equalizer. The more you understand about how the system actually works, the harder it becomes for anyone to take advantage of it. I want to hear your thoughts on this. Head down to the comments right now and tell me, are you going to audit your 401k fees today? Are you going to switch your allocations from expensive active funds to low-cost index funds? Have you already made this switch and seen the difference? Let me know below. I read and respond to every comment. If you found this video valuable and you are committed to protecting your financial legacy from hidden Wall Street fees, please hit that like button, subscribe to the channel, and ring the bell notification so you never miss our weekly wealth protection blueprints. Remember, building wealth is hard, but keeping it is harder. Long-term financial security is a reality only for those who plan, verify, and refuse to be taken advantage of. Stay prepared, stay protected, and I will see you in the next video.